Hello and welcome to this presentation. My name is Greg Klein with Hayes Financial Group. We will be discussing loans, hardships, distributions, and I just have to give you the caveat that I am not a tax advisor. Taxes factor into taking money from a retirement account, obviously, and taxes are very personal to your situation. So any discussion of tax implications should always be consulted with whoever helps you do your taxes. Now, without further ado, let's get started. We will walk our way through loans, hardships, and distributions in that order. And before I get into the details of the loans, which is our first topic, I just want to make clear that every plan is different. Every situation is different. This is general information. To know what applies to you and your plan specifically, it is best to check online or call a company that holds the money and administers your employer's retirement plan. But so that we are all on the same page and understand these different options, I'll do a brief overview starting with the loans. Loans are a temporary withdrawal of money from your retirement account. They are paid back, and a general purpose loan is a loan that you can take for any reason. You don't have to document the reason. You pay the loan back over a maximum amount of time of 5 years. There are other types of loans like home loans that may last longer, but just for overview purposes, general purposes, a loan is paid back over a maximum of 5 years. There is typically a processing fee involved. The processing fee can be a quarterly fee, a one-time fee that you're charged for taking that money out of the account. There are no taxes on a loan, so it's not taxable unless you default and do not pay the loan back, which is a situation that we'll get into in just a couple of moments. A hardship distribution is different from a loan. It's a specific permanent distribution for a documented reason. So it's money that will come out of your retirement account that you won't pay back, so it is subject to taxes and a possible penalty. We will go through the specific hardship reasons in just a couple of minutes so you understand what those are. Documentation is required to prove that you're using the money for that hardship reason. Lastly, distributions are what you have available when you are no longer working for the company, separated from service or of retirement age. So these are permanent distributions subject to, again, taxes and possible penalty if you're under age 59 and a half. And this is where your different sources of money come into play, like pre-tax and after-tax or Roth money. And we'll get into some scenarios looking at distributions as well. A loan, if available, will generally be your first option if you're still actively employed at the company. And a few tips if you're taking the loan are, just like any distribution, try to make it a last resort, but be sure to assess your options, other options that you might have within the retirement plan or outside of the retirement plan from private funding. Keep contributing. We'll see in just a moment why it's so important when you have the extra loan payment coming out of your paycheck to still contribute to your retirement. And then my suggestion is to increase contributions when you're finally done paying that loan off. Increasing contributions when you're done paying off that loan is a perfect time because you've already had more money coming out of your paycheck for your contributions as well as your loan payment. So when you're done with that loan payment, put some of that loan or money that you used to pay on the loan towards your retirement with additional contributions. Things to avoid with loans and as well for other types of distributions is, well, number one, check on your plan, see how many loans you're allowed. If you're only allowed one loan, figure out exactly how much you need to take and don't take more than you need. You don't want to be pulling more money than you absolutely have to out of your retirement at any time until you do finally reach retirement. And then don't stop saving for retirement. I can't stress enough keeping your contributions going into the plan. You don't want to miss out on any match for sure. And then go in with your eyes wide open. Don't have an outstanding loan and then leave your job without knowing the repercussions. And we'll discuss that in one of our loan scenarios coming up right now. Let's next look at a few different loan scenarios, and we'll start from really the best scenario to the worst. The best scenario with a retirement plan loan is to take the loan and then continue to save, which is what we show in this example. It's a $5,000 loan over 5 years. The person continues to contribute to their retirement account, which is absolutely key. Too many times, because when someone takes a loan and they have an extra loan payment that starts coming out of their paycheck, they will reduce or stop their contributions altogether, which is what causes the biggest pain. Also in this scenario, you'll notice that the loan interest rate is 5%, and the investments in the person's account just so happen to earn 5% too, which factors in. All this being the case, keeping up the contributions and the interest rate they're paying to themselves is the same as what they would have been earning on their investments. It really doesn't cost them anything if they pay back the loan in full. It might cost them some fees, either that one-time or quarterly fee. One could argue that there is still a cost because paying yourself 5% interest on a retirement plan loan over 5 years, like this example shows, is not the same as earning 5% from your investments. I would much rather have someone else pay me 5% than have to pay myself 5%, but at least there would be minimal impact on your account and progress towards your retirement savings goals. Scenario 2 is what we see quite often. It's when a person takes a loan and then stops saving in their retirement account. So we see the same setup, $5,000 loan over 5 years, 5% interest rate, but zero contributions and zero match going in each month. Things were already tight financially for this person, and now they have to make a loan payment from each paycheck, and stopping their contribution can cost them upwards of $1,000 over 5 years. $1,000 forfeited in retirement savings might not sound like a lot, but for a $5,000 loan, it's a pretty steep price to pay. And in just 5 years, the life of the loan, that's what it costs you. But if we stretch it out and look at a longer time frame, we see that projecting out 30 years when this person gets to retirement, that $5,000 loan that they took years ago and stopping their contributions for that 5-year period could cost them almost $7,000 in lost savings. There's lots of variables with loans that can increase or decrease the impact on your retirement. These last two examples have the interest rate of 5% equal to what the person's investments in their retirement account would earn. This is not generally the case. Your investments historically would earn a lot more than the interest rate that you pay yourself on a loan. It's possible that investments could decrease in value, and taking a loan and taking money out of those investments could benefit you over the long run. But we'll also look at a scenario where the investment return is a little bit higher. A higher longer-term return of 8%. Now that $5,000 loan and stopping their contributions for that 5-year period could cost this person upwards of $17,000 in lost retirement savings. And so we're seeing that impact. $17,000 in lost retirement savings could mean that you have to work another year before you retire. And no one wants to do that. When you reach the point that you want to retire, you don't want to think back, gosh, I regret taking that loan because now I'm stuck working a little bit. Keep in mind, when taking a loan, stopping your contributions is the biggest killer by far. Last loan scenario shows defaulting on that $5,000 loan. If this person paid on the loan for a year, so they paid $100 a month, they paid the balance down to about $3,800, but then they had an abrupt change. They left their job, they lost their job for whatever reason. Now the outstanding loan balance of $3,800 has to be paid back into the retirement account, or it's subject to taxes and a penalty if this person's under 59 and a half. And those taxes add up quickly. Not even the highest tax bracket, but you see in my example on this slide at 12% federal tax rate, a few percent for state income taxes, the 10% penalty. In this hypothetical example, they would be slapped with a tax bill of over $1,000 on that remaining loan balance of $3,800. The loan will often be your preferred option because it's a temporary withdrawal of money, and you pay it back into your account. Go in with your eyes wide open. If you're in an unstable employment situation, don't take a gigantic retirement plan loan, because if you find yourself without a job, you have to pay the remaining balance back into your account, or it becomes subject to taxes and a penalty. If that employment situation of yours changes and you default on the loan, the 10% penalty tax for being under age 59 and a half, that alone is really enough to wipe away the benefits that you would have seen by borrowing from yourself, from your retirement account. Taxes and that penalty can be avoided by paying a loan off in full, but with our next option, the hardship, that's a permanent withdrawal, and it's subject to right away to the taxes and possible penalty. But before you even worry about how much you will owe in taxes and a penalty for a hardship, you You first have to determine if your plan allows them and does your situation qualify. There are specific reasons that are designated as hardship reasons. First is medical care expenses for you or your spouse or dependents, costs directly related to the purchase of a principal residence, and you can't have owned a home in the past couple of years for it to be considered a principal residence. This does not count mortgage payments. This is costs related to the purchase of the residence. Amount you need to prevent eviction or foreclosure. Expenses incurred to repair damage to your principal residence, and this has to be something sudden, unexpected, like a natural disaster. It can't just be long-term wear and tear to your residence. Tuition and related expenses apply for you or your spouse or dependents. And finally, funeral expenses for, again, your spouse or dependents. When comparing loans and hardships head-to-head, the taxes and penalty will be the biggest differentiator. Remember, if you borrow from your retirement account and keep up your contributions, don't miss out on a big run-up in the stock market, you pay that loan back in full, which is a lot of ifs, I understand. But if all that falls in place for you, it won't cost you a fortune and you won't have to pay the taxes and penalty. The hardship, if you're under 59 and a half, which you almost certainly are, otherwise you wouldn't be needing to take this type of withdrawal, you would have to pay the taxes and 10% penalty. So to get the same $5,000, like we showed earlier with our loan scenarios, you would have to take $6,850 from your retirement account in the form of a hardship withdrawal. This is because of those pesky taxes and penalty. This example saying you have to withdraw $6,850 to get $5,000 net takes into account 12% federal tax, some state tax, a 10% penalty. And so the hardship can be much costlier because taking out $6,850 from your retirement permanently is going to impact your retirement savings a lot more than a $5,000 temporary loan. Our third option for accessing retirement money is the distribution. This again is when you would have this option available after you've separated from service or reached retirement age. With distributions, it's when we talk about that all-important age of 59 and a half, there is some gray area or some exceptions to that 59 and a half age rule that I will get into, and then having multiple sources of money. If you can, like pre-tax and Roth, if your plan allows you to save both pre-tax and Roth, this will impact how you might want to take that distribution, and we'll look at examples of that as well. First, distributions. Once you have retired or separated from service, they open your options wide up. As I say, they really take the handcuffs off. So you would have options to roll your money over to another retirement account, take a lump sum distribution in cash, potentially take out money in installment payments. You might also be able to, or you might want to, not touch the money and leave the money where it is in the plan. The point is you would no longer be restricted to borrowing up to 50% of your balance for a maximum of 5 years, or $50,000, which is generally the maximum for a general purpose loan. Or you wouldn't have to document why you want to take the money like you would for a hardship. If you're separated from service, you're of retirement age, now it's really all up to you what you do with that money. I mentioned multiple times that age 59 and a half rule to avoid the early withdrawal penalty when taking money out of a retirement account. But I also wanted to point out briefly there are some exceptions to that rule when it comes to distributions. And the first one is age 55. And that is for employer-sponsored plans like 401k or 403b. This rule does not apply to IRAs or individual retirement accounts. Age 55 rule states that you would not have to pay the early withdrawal penalty of 10% for distributions before age 59 and a half if they are made in the calendar year in which you separate from service and turn age 55 or older. Again, not a rule that applies to IRAs. So if you take money from your 401k, 403b at age 56, you roll it over to an IRA, then you would have to wait until age 59 and a half. But if you retire, separate from service at age 55 or older, you could potentially pull out of a 401k or 403b and not be faced with that 10% early withdrawal penalty. Their exception is what is called substantially equal periodic payments, or also 72T periodic payments. These are payments beginning after separation of service, and they have to continue for at least 5 years or until you reach age 59 and a half, whichever is longer. For example, if you retired at age 53 and began receiving payments right away, you would have to keep up those payments for the longer of 5 years or until age 59 and a half, which would be, in the case of retiring and starting to withdraw at 53, until age 59 and a half. If you retired at age 53, but you started taking those periodic distributions at age 57, that's still earlier than 59 and a half, but you'd have to keep that up for at least 5 years. To say there's a lot of I's to dot and T's to cross when we're looking at these exceptions, especially the substantially equal periodic payments. I just wanted to make you aware of these exceptions. Always check with your tax professional to make sure you do things right. We don't want you to go and start taking distributions and get hit with a bunch of taxes and penalties that you weren't expecting. So when you're at that point of taking distributions, your age is a major factor. You also have additional flexibility if you have multiple sources of monies in your account, like both pre-tax and Roth. Again, if your plan allows it. Both pre-tax and employer match sources are what I call tax me later variety. So those are monies that are not taxed when they're deposited. They're taxed when you begin to take that money out. So you've not paid any tax on this money, and whatever you withdraw would be subject to taxes. So we have some more examples for you. First, let's understand tax brackets, which are listed on the left-hand side of the slide. I'll probably understand that the more you make, the higher tax percentage you pay, and you can see on those tax brackets, they start at 10%, go up to 12, 22% on money that you make, or income, I should say, that you make over $84,200. And so those are going to factor in when you're taking distributions from your retirement account, like this individual on this slide that has $500,000 saved in their retirement account, all of the pre-tax variety. If this person had $500,000, all of pre-tax or employer matching contributions, and they decide they're going to take $50,000 out of their retirement account a year, that $50,000 is going to be subject to income tax. So on the left-hand side, we see $50,000 would push them past the 10% and 12% brackets up into the 22% tax bracket. Note that the 12% bracket is on everything under $39,475, because we'll come back to that in just a moment. But some of that $50,000 that they withdraw would be taxed at each level. And when we add all this up, it'd be almost $7,000 in taxes, an effective tax rate of almost 14% on that $50,000 that they withdrew. Now, if you had a combination of pre-tax and Roth in your account, it would afford you more flexibility. That's our example on the right-hand side. Remember that tax bracket that I mentioned, the 12%, it goes up to $39,475. So to stay below a certain tax bracket, you could take up to $39,475 out of your pre-tax bucket of money in your account and stay below that 12% bracket. But if you needed $50,000 total, like this person, you would take the first $39,475 out of the pre-tax bucket, and then you could take the other $10,525 out of the Roth bucket, which is money that's already been taxed that you would not have to pay taxes on when you pull it out of your retirement account. And that saves taxes, pushing the effective tax rate in this situation down to about 9% compared to almost 14% before. That's the flexibility that comes with having different sources of money in your account, both pre-tax and after-tax or Roth. You can control your tax situation better and pay less taxes by staying below a certain tax bracket. So just like with your investments, by spreading your money out and diversifying, it offers you more protection, better returns over time. Diversifying your monies in terms of their tax treatment when you take them out at retirement, it offers you flexibility as well. I wanted to touch on briefly this topic because it's something new that came out with the CARES Act that passed at the end of March. Not all plans have this available. So this was a change, temporary to a change to the rules that guide retirement plans. And so, as I've said with other things a few times already, it's best to check with your plan administrator. Go online, call your provider to see if any of this applies to you and your plan. The new law did make it possible for some retirement plans to allow for larger loans. I've mentioned that typically loans are up to 50% of your balance or $50,000. You see that the CARES Act allowed for larger loans of up to $100,000 or 100%. It also allowed for some suspension of loan payments for a period of time in 2020. The new distribution that was created is something called a COVID or corona-related distribution. Type of distribution would be for those qualified individuals. That means people impacted directly by COVID-19, and allows the possibility to take a withdrawal similar to a hardship, but different because there's no penalty on that. And then it does allow you 3 years to pay the taxes and spread them out over time. So qualified means that you've been impacted by COVID-19, so it doesn't mean just anyone can request this sort of distribution. And I repeat, if your plan allows it, you want to be certain you do it right so that you don't get hit with taxes and penalties later on down the road for taking a COVID-related distribution. But I wanted to mention this as it is a very recent change to the law. Loans of 50% or $50,000 and the normal hardship reasons that we went through, they're still the hard and fast rule, but the CARES Act and the measures taken during the pandemic might allow you an exception to some of these rules. In closing, review all of your options, whether it's loan, hardship, outside funding. If you do take a loan from your retirement account, pay it off as quickly as possible. You don't want to default on that loan, and you never know when your job situation might change abruptly. Keep contributing while you are paying on that loan. Don't take more than you need. That is, especially in terms of distributions. You or your spouse find yourself without a job and you're looking to tap into a retirement account where you can take a distribution because you're separated from service, don't take more than you need. You might turn around and be employed again in a couple of months. So you don't want to go and liquidate an entire retirement account, pay a bunch of taxes and penalty if you could have just left that money alone. Just take what you need, and then multiple sources will give you more options like the pre-tax and Roth. So think about that as well for your future. As always, I'm here for you. Email me, give me a call or text if you have additional questions. I sincerely appreciate your time listening and watching this presentation. And stay well. I will communicate with you in future meetings. So thank you again, and take care.